Hi, this is Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Sharif Abdu and Charles Moran. We here at Value Line hope you and your family are staying safe and dealing with this difficult time as best as possible. Today, we're going to provide an update on the coronavirus and its ongoing impact on the economy and stock market. We will also discuss the actions Value Line is taking to help our subscribers navigate through this difficult time. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York-based corporation that has been providing investment research for more than 85 years. Our flagship product is a Value Line investment survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Now let's discuss the coronavirus, the economy, and the stock market. This content was prepared by Harvey Katz, Value Line's chief economist. The investment picture is mixed. First, there is the economy, which swooned in late winter, rebounded in the spring, and more recently has faced new headwinds from a surge in COVID-19 cases. Second, there are corporate profits. Reporting season has been challenging, even though many companies have beaten restrained expectations. Then there is the Federal Reserve, which continues to support growth by keeping interest rates low and funneling huge sums of money in the economy. This is helping banks, business enterprises, and households better handle the difficulties brought on by COVID-19. Finally, there's the fiscal situation, where earlier stimulus programs are expiring and new proposals are yet to pass in highly partisan Washington. Let's consider the outlook in each area. The economy. The numbers are still supportive, with recent reports showing strength in retail spending, industrial output, and housing starts. But such surveys covered June and reflected conditions in place before the end of the month or prior to the spike in COVID-19 infections. Data on jobless filings, which are collected weekly and remain stubbornly high, are more telling. In all, we think the releases for July and August, which will take into account the increase in coronavirus infections, will give a truer picture of the unfolding third quarter. Earnings. Corporate America is holding its own, with key industries navigating choppy waters quite well, especially in the tech and large pharmaceutical areas. The good showings by stocks in these sectors reflect generally healthy earnings numbers. Conversely, energy, airlines, and recreation are struggling and may do so for some time. Monetary and fiscal efforts. On the monetary front, we expect the Federal Reserve, which recently met and is very concerned about the pandemic's effect on the U.S. economy, to continue channeling funds to support growth. Things are murkier on the fiscal side, though, where Congress and the White House had yet to resolve questions on payroll taxes, health care, and employment as it went to press. In conclusion, things are uncertain on a number of fronts, but with Wall Street having proven resilient to this point, any sustained increase in clarity could be warmly received. Please refer to the inside cover of Selection and Opinion for our own statistically based asset allocation model's current reading. I want to touch on one of Sentence Harvey's view, and I quote, "But with Wall Street having proven resilient to this point, any sustained increase in clarity could be warmly received." We certainly hope this is the case, and maybe the odds are in favor of such an outcome, but we still have some concerns. As stated earlier, the current economic situation remains difficult, and it's going to take a while to recover. Many in the medical community also assume that a second wave of COVID cases could hit this fall or winter, which would, of course, significantly hamper recovery, as well as introduce new problems. While I don't think that the stock market will retest the lows of February, I would not be surprised to see some backtreading, and even if the major indexes do advance from here, it probably won't be a straight line. Thus, we recommend that investors tread carefully and prepare for a bumpy ride. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, more importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am currently located. This is the main landing page for subscribers. Under the quick link, click on Supplementary Reports. As you can see, the research department has been very busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. We are also aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Consequently, corporations have been implementing cash-saving initiatives such as headcount cuts, the slashing of advertising budgets, and reducing or eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to the rapidly deteriorating balance sheet, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary and rankings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. And now we're going to move on to our stock screener. Specifically, we're going to look at our one stock to buy right now. For this, let's go to the screener. Value line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE line. Since I earlier preached caution, I'm going to create a screen that only focuses on the most stable and successful issues. There are loads of risk measures out there and several that Value Line offers. Now I'm going to start with our time-tested safety ranks. The safety rank measures the total risk of a stock, and it's arranged on an easy to understand scale of 1 to 5, with 1 being the most conservative. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. At the same time, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. I'm only going to focus on the stocks ranked 1 highest for safety. These are the largest and most stable equities under our coverage universe. In fact, of the 5,700 stocks or so stocks in our database, you can see that only 122 garner this top rank. Now let's go with an additional level of security. As mentioned earlier, loads of companies are reducing headcount, taking on more debt, and eliminating their dividends. Thus, balance sheets have greatly weakened. Although it's already a factor in the calculation for safety, I'm going to double down and include financial strength. These grades range from C to AA+ in 9 increments. And I'm going to go financial strength ratings of A++. As you can see, this cuts our list down even further to 55 prospects. Now, let's narrow that list even further by looking at price potential in the year ahead. For that, I'm going to include timeliness, which is a proprietary Value Line measure evaluating a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. I want to focus on the stocks that, based on our projections, have the most promise in the near term. So with that, I'm only going to pick stocks that are ranked 1 for timeliness. As you can see, our list is now down to 15 prospects. Now we want to whittle that list down even further. And for that, I'm going to focus on the dividend yield for the pool of stocks that we have so far. So for my final screen, I'm going to select the dividend yield. And for a lower bound, I'm going to put the lower bound at 2.5%, which is slightly higher than the current Value Line median for all the stocks under our coverage. With that, we're down to just 5 stocks. As you can see, these are all large, well-capitalized companies with long track records of steady increases to the payout. You certainly can make an argument for any of our remaining stocks, and investors interested in adding new positions should consider them. However, only 1 can be today's 1 stock to buy right now. And after consulting with a number of my senior analysts, we prefer and recommend CVS Caremark, ticker CVS. Before I go into specifics, please note that the screens can be saved and revisited by utilizing the button at the top. Let's now click on CVS and get some additional information from Value Line's digital report. In the banner section of our reports, you will notice the stock is now trading at roughly $64. Our 3 to 5 year projection is 95 to 115. Clearly, we think the stock has room to run. Now let's take a look at our last full page report on CVS. This report was published last month. As you can see in the statistical array, or the center of the report that includes the financial data, CVS appears poised to achieve healthy annual increases in revenues, profits, and book value, among other measures. We look for the company to post relatively stable results this year, which is a good showing given the recent state of the economy. Pharmacies are considered essential businesses and have stayed open throughout the COVID-19 pandemic. While consumers stocked up on pharmaceutical needs earlier in the pandemic, overall foot traffic has declined some. The company's balance sheet remains in pretty good shape, with cash on hand of about $12.7 billion as of the end of the March quarter. This provides a level of support during these difficult times. All told, we think CVS's current position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few were submitted prior to this presentation. And now I'm going to turn it over to our two senior analysts to answer your questions. Sharif and Charlie, the floor is yours.
Okay, thank you, Alan. I just wanted to thank everybody for joining us today, and I will answer the first question that I thought was, excuse me, of some interest. One of our participants asked, other than the safety rating and financial strength, how can I measure the financial strength of a company using value line reports? Excuse me. So if we look in the bottom right corner of the full page value line report, you'll find the financial ranks box. And Alan, if you can please pan down to the bottom right corner there. Thank you. So there you can see that in addition to the company's financial strength rating, in this case for CVS, it is an A++. So in addition to the financial strength, we also include the stock's price stability, price growth persistence, and earnings predictability. So for CVS, the price stability is 75, price growth persistence 45, and earnings predictability, which is a perfect 100. So what do these numbers actually mean? So for the price stability of 75, that means that of all the issues that Value Line covers under the Value Line Investment Survey, so that's 1,800 stocks that we cover, that means that CVS ranks in the 75th percentile. Roughly out of 100, it's going to be in the top 75 or so rankings. The same goes for price growth persistence and earnings predictability. So price growth persistence is, you would say it's kind of middle of the road, and earnings predictability, which is obviously a very important measure, scores a perfect 100 out of 100. Another number that I like to look at personally, and I think it bears paying attention to. Alan, if you can pan up a little bit to the capital structure box. So one number I really like to pay attention to is the percentage of debt to total capital. So in the case of CVS, that number is 50%. Now, what does that number mean? That means that if you take all the capital that the company has available to it, or is currently using, that would include shareholders' equity and total debt. Of that pool of money, debt represents roughly 50% of the capital that the company is currently employing. And 50% it's a good number. It's not. It means that the company is making adequate use of leverage without being what you would call highly leveraged or at risk of putting its quarterly results at risk. For example, if you have a company that's too heavily leveraged, if its performance takes a hit in any particular quarter, its top line performance takes a hit, interest expense may really weigh on margins and could really impact earnings. Whereas a company that is like CVS, where it's making good use of leverage without being too leveraged, it should be fairly stable and able to easily cover its interest expense without making an impact on its quarterly results. I'm going to hand it off to Charlie at this point.
Thank you, Sharif. My name is Charlie Moran. I am a senior analyst at Value Line, and I got a question from gentleman Michael, who asked about the reporting date and why that cannot be included in the company profile. And thank you for scrolling down a little bit. Sharif mentioned the financial strength box. If you look to the left, you'll see the footnotes, and within the footnotes, we will include a date, or excuse me, not the specific date, although companies sometimes, if you do go to their website, will record a specific date, but generally our footnotes will include the next month in which quarterly earnings will be reported by the company. And to be a little bit more specific, we might reference the early, mid, or late stage of a specific month for the specific date. I would caution, though, that with smaller companies that are less followed, sometimes the dates are a bit tenuous, and so you don't know specifically the period because they just won't simply release a specific time. Let's see what else. I did also get another question while I'm here with I guess it was Jeff, who was asking about the how the technical rank is derived, and I just wanted to make sure that people were aware that the technical rank, although you see it, thank you again for scrolling up. As you can see with CVS Health, the technical rank is beneath the timeliness rank and the safety rank. We are not privy to the calculations to derive the technical rank. However, that is a quantitative ranking, a proprietary prediction of the coming performance. As you can see in CVS's case, the technical rank is 4. And I'll toss it back to Sharif. Sharif?
Thanks, Charlie. Let's take a look at another question. This question was submitted by Elise Allaire. And the question is, why do some stocks not have the debt percentage in the capital structure box? Which is an excellent question. So, excuse me, one of this full page board is that it's all this information, it's information rich, information dense, but it's all presented on one page. And we really try to only present information that is relevant for that company within that industry. So for example, specifically discussing the debt percentage, for industries that are less capital intensive, like let's say financial services, we typically don't put the debt percentage in the capital structure box. For industries that are more capital intensive, which is most of your standard industrials, we do include the capital, the debt percentage, the percent of debt to total capital. So for example, if we take a look at a company like Citigroup, the debt percentage is not included on the page. And the reason again is because that type of company in that industry is not as capital intensive as for, like, let's say, for example, a company like Boeing, or a company like Simon Property Group, which is a REIT, one of the largest mall REITs in the country. So we really want to just present the reader with information that we feel is relevant for that company and that industry, without overwhelming the reader with information that we feel is less relevant for making an investment decision. While I'm here, I will take one more question. Terry Shockey asked the question, for CVS, why is there a difference between return on shareholders' equity and retained to common equity? And that is a really good question. So if we take a look at the array, which is the large grid of data that you see in front of you, it includes a number of different measures: sales, gross margin, operating margin, number of stores, et cetera, et cetera. And we look at the measures for 2019, the last full year that a 10K annual report was available for CVS. So shareholders' equity, the return was 14.5%. Retained to common equity was 10.4%. So we see that there's a difference there. So what does that mean? So we're really trying to tunnel down and give the reader different perspectives on the company's financial performance, right? So for example, return on shareholders' equity for the year, 14.5%. That number is derived from taking the net profit for the year and dividing it by the total shareholders' equity. Okay, so that's more of, I guess you could say, more of a broad number, because it's a very basic calculation. We're just looking at net profit, and we're just looking at shareholders' equity, one big lump sum, shareholders' equity. So why is retained to common equity on the page? The reason is, excuse me, we really want to give a more specific, more pinpointed number as a measure of the company's financial performance. So for example, here, the calculation is derived by taking earnings per share, subtracting the dividend paid per share, and then dividing that number by just common equity. So you're not including any preferred shares. Now, in the case of CVS, there is no preferred stock. The company does not have any preferred stock on its balance sheet. But still, you're taking the earnings per share, you're subtracting the dividends paid per share, you're multiplying that number by the number of common shares outstanding, and then you are dividing it by common equity, strictly common equity. Not shareholders' equity, strictly common equity. So it's meant to strip out some of the impact that a dividend would have on the company's returns. That's really what we're trying to do here. So let's say CVS did not pay a dividend. What would we expect the numbers here on the page to be? Since the company does not have preferred stock, what would we expect the returns to be? In this case, we would expect that the return on shareholders' equity and the retained to common equity would be identical. They would be the same number, because what we're trying to do here is strip out the impact that the dividend would have on the company's returns. But in this case, you know, if it wasn't paying a dividend, then the returns would be identical. Return on shareholders' equity and return to common equity would be identical. I am going to kick it over to Charlie. Charlie, if you have another question that piques your interest, would you like to take over?
Sure. Thank you, Sharif. I had another question for Robert, asking simply about the yield for CVS, and that is a simple calculation that is on top of the page that is next to the PE ratio, and to the stock price over there is it's the furthest number to the right, and it is 3.0%. Thank you, Robert. And then the final question I had was regarding the a more pointed question from Andrew about how he can use Value Line to get a sense of the safety of a company's dividend and their ability to pay it. There's no rating system or number or calculation that we give Andrew regarding a company's ability to pay the existing dividend. As Sharif alluded to, in terms of the financial strength ratings and the debt to capital ratio, you can get a sense from looking at those figures, as well as the current position box measuring working capital, which is in the middle of the page to the left beneath the capital structure box. Also in the array, which is the grid that we alluded to prior, the final line item is all dividends to common, I believe, and you can get a sense as to how much of the profits companies make are being paid out by a company in terms of granting their dividends to shareholders. And again, those are probably the best measures one can look to get a sense as to a company's ability to pay out their existing dividend. But again, we don't have a number or a summation expressed in a number like with price stability or earnings predictability. But I hope that gives you a greater sense of trying to predict a company's ability to pay out their existing dividend. And that was all the questions that I had. Sharif, Alan?
That was only, those were the only questions that popped out at me, Charlie. I think unless Alan has something else that he would like to address, I think we can wrap things up.
I think I'm okay. I thank you very much, and thank you guys for answering the questions, and thank you everyone for joining us today.